These are trade management essentials. And what do we mean by trade management? It means we have a candlestick signal, and let's say we also have it confirming a Western signal. But do you buy it? Do you sell it? Do you stand aside? And then once the trade is initiated, monitoring the trade. And this is one of the most dangerous misuses, and something I've referred to time and time and time again, about treating all candlestick signals the same. Okay, candles are a tool, they're not a trading system. Okay, you could have the exact same candlestick signal. I'm going to look at a lot of instances of this aspect in this section, and how you trade or don't trade with them is very, very different. Okay, pick a card mentally. Okay, everybody got a card? All right. Your card's missing. And the reason for that, it's very simple, is because all the cards are different. Right? They're all different. But the reason a lot... So I thought I was a genius, huh? But the reason I wanted to show you this is because those who just look at candle lines or candle patterns without looking at everything would say, okay, they wouldn't recognize that they're all different. But for those who saw they were different, of course your card's not going to be over here. So, and this brings the idea of candles in context. So here, now we have a candle signal. Now what? Right. That's what we're here for. Now what? Okay, I had this cartoon made up. Guy at a hammer trying to bang in a nail with, what is that called, a caliper or something? Wrench, yeah. And it says, first you must learn how to use the tools. So as we move up the steps of knowledge, we're going to learn how to use the tools of candles. Okay. You can use candles to exit. And it's as simple as this. If a candle signal does not confirm another signal, whether it's a Western signal or one of your signals or even fundamentals, I don't disparage fundamentals. Especially the longer the time you're trading, longer the time frame. If a candle signal does not confirm another signal, then use the candle signal to offset a trade, assuming you're in a candles to enter a new trade. If a candle signal is confirming another signal, it's a necessary condition, but not sufficient. Sounds legalese for a new trade. Okay. And we'll look at exactly what that means in a little bit. We looked in the prior session about east and west confirmation, where a candlestick signal confirms a Western signal. So, just to refresh your memory, here we have a resistance area shown by the green horizontal lines. And as the market's creeping up to resistance in the blue ellipse, upper shadows, right? We wind up with the dark cloud cover. Here we have an evening, this is not an evening star, this is a bearish engulfing pattern. We know this is not an evening star because it didn't get one. Right, exactly. So here we have candle signals, upper shadows, smaller real bodies, dark cloud cover confirming resistance area, a hammer confirming support. So now we've looked at candles. We spent a lot of time for the first leg of the trading triad on candle charts. We looked at Western technicals, and now we're going to be looking at trade managements. And from one of my resources, when I was doing the original translations and the original research back in the 1980s, from one of my Japanese contacts at a major shop in Japan, he faxed back to me. He said, and this is a nice way of putting it, minor adjustments must be made because to know where you stand is more important than an individual candle signal. Candles in context. So these are the aspects we're going to be looking at in this portion, the third leg of the trading triad, trade management. We're going to look at protective stops, price targets, which we touched a little bit on with Western Technicals, risk-reward, prevailing trend, and there's two aspects to trend. The news, my if-then principle, which I made some references to yesterday, and being a market chameleon. So we're going to go through each of these. Okay, protective stops, i.e. risk management. Okay, when I was doing research on the candles, the challenge was, although my translator was able to translate the material, a lot of the references, and the gentleman from Japan, I'm sure, can confirm this, the Japanese do a lot of references by metaphors and analogies. So I had to understand Japanese military history, a little bit about their culture, the sociology. So it was not just getting the books translated, it was understanding their culture and their background. And so I had to read about samurai history and things like that. And one of the samurai, famous samurai generals said, of all the stratagems, to know when to quit is best. True. And it's hard for us to admit we're wrong. It's human. It's just human nature. But that's what risk management is all about. We have to know when we're wrong. The traders who stay around longest, and we saw that when I showed you my P&L from yesterday, from when I was making trading recommendations, had more losses than gains, but I was able to cut the losses. The ones who get blown out of the water are the ones who think they're smarter than the market, and they either don't have a stop or they adjust the stop after. The best time actually to put a stop in is before you put the trade on, because that is when you're most objective about the market. So, but you have to be able to do this. But you said you loved me. Well, I changed my mind. I work with a cartoonist, Dave Carpenter. And if actually anybody does seminars, I'll be glad to give his contact information. He's great because actually I saw a lot of his cartoons in one of the books. I got in contact with the author, and she was nice enough to give me his name. So I come up with the idea, and he comes up with 3 or 4 different cartoons, and I pick the best one. So, all the cartoons I had today were done by him. So again, if anybody does seminars, I'd be glad to pass your name on. I'd be glad to give you his name. So anyway, let's do this by risk management by candle by candle. Okay, and this is 1 of 4. Markets in the downtrend. By the way, I just wanted to show here, this was change of polarity. Support, so you have the support level. Actually goes all the way back to here. Old support becomes resistance, but I want to focus on this aspect here. So here we have a hammer confirming a support level. Looks fine. Okay, so we'll look at risk-reward later, but based on this, I think it's a good risk-reward trade. Because if we're looking at change of polarity, which is all the way up there, okay, let's move. And this shows you, that's a morning star. This is actually a classic morning star in that red arrow. And this is pretty rare. Now, just because it's rare doesn't mean it's more powerful, but it's just more classic, so the odds are it's going to work better. So here we have a classic morning star because the black real body, the market gaps down. The real bodies aren't touching. That's not a window, right, because the shadows are overlapping. But the real bodies don't touch. And then the third candle, there's actually a rising window, but the third candle doesn't touch the real body of the second candle. So this is a classic definition of a morning star. Okay, now, black wrapping around the white. Is that a bearish engulfing pattern? We're going candle by candle now. Is that a bearish engulfing pattern? No. Okay. And once again, I didn't focus a lot on trend. We're going to look at that a little bit later, about candles and trend, but I did touch on it yesterday. But even before I focus on it in a couple of minutes, it's important to remember that the candles as reversal signals need trends to reverse. So a bearish engulfing pattern has to come after an uptrend. Was that an uptrend? No. So it's not a bearish engulfing pattern. So we're still okay with the hammer. A little nervous here, right? But still a hammer. Okay. Now we're continuing to move along. And what's happening? Here's the hammer. And is the hammer still holding as support?
Yes.
Right. But what's happening now? Yeah, it has a resistance area. Now, we're going to be talking about protective stops. There are other things like called trailing stops and time stops. Again, something that we just don't have time to do in this session. You can see we have so much already. But there are time stops and trailing stops. And something like this, if the market's treading water for 4 or 5 sessions, I would think about lightening up. Okay, that's a time stop. Again, something that I spend more time on with other resources, but just to give you a little sense of it here. But nonetheless, barring that, the hammer's still holding a support, but now the market's hesitating over here. This is where you would be stopped out of your long position on the blue, this arrow over here. The market broke under support over here. So if you're long, you're wrong. Now, what should be resistance? It didn't get to there based on this. But now that the market closed under here, what should be resistance? Old support, yeah. And you can, this should be a really good support, resistance area over here. But even forgetting about this stuff over here, even forgetting about this, okay, this was certainly tested. Again, I got to find the here. This was certainly tested enough to use change of polarity. But by getting out there, by the market doing that, it told you that obviously the support was not going to hold, didn't hold. Okay, lots of reasons to be bearish. Dark cloud cover at the first red arrow on the left. Doji, bearish engulfing pattern. Over here, evening star, doji, spinning top. Okay, this is a resistance zone over here, and I'll draw it. So we know this is potential resistance between the high and the doji in the prior candle, right? And this is another resistance area here. As soon as the market gets above there, you're out. And yes, it's painful to do that, but look at what happened. Whoops. Look at, that's on the right side in the blue arrow is where you would have exited from short positions. Okay, and look what happened after. Again, it's a little hard to see on this chart, but the market just really galloped along. And once again, with options, if you're doing spreads, you could leg in, leg out. Bearish engulfing pattern at my favorite candle signal, the window, the falling window. Didn't work. Market closed above the window. You're wrong. Okay, a series of doji over here. This is a gravestone doji. Remember, it's a shooting star, where instead of the small real body, we have a doji. It's a gravestone doji. Doji over here, a doji over here, and for quite a while it was resistance. Once the market gets above it, it's a bullish breakout. If you're short, you should be out. If you're flat, what should you be doing on this day? Looking to get in. What price says you're wrong? Yeah, I would use a change of polarity, right? Old resistance becomes support. So whether you're long, you're short, there always has to be a price that says you're wrong. That's where the protective stop is. Okay, stops. The Japanese have an expression or a proverb, when the boat reaches midstream, it's too late to stop the leak. Look at all the reversal signals. Doji here. If the market gets above it, bullish breakout. So if you're short, you're wrong. Little rising window over there. And in the ellipse on your left, we have a resistance area. The market did break above it. And actually, you could view this, you could probably get a swing target. You take the height from here, and you add it to the breakout point. So in other words, over here, the breakout point. But here, the market had a resistance area here, and it did hold. And one of the things you could do, once again, on an intraday basis, just to touch on it briefly here, you may look at an intraday chart to see if there's any turning signals here, right? And if there's not, give you an indication. Maybe the odds are a little higher. It's going to break out. You don't know until it does. And over here, you may have had a shooting star in the first hour of trading here. And I know, we had a lot of nice comments about the intraday stuff. Those early reversals are really a boon for those who, even if you don't trade intraday. Just, once again, just an idea. So I just want to have a lot of them that have stops, just to show you how to use it. And you see how I use change of polarity all the time. It's so good. We're going to look at price targets now. And we did discuss ways of using Western technicals, measured moves, and so forth for price targets. And the reason I want to talk about it is because this is going to become part of a trade management aspect that's really important. So, one of my trading principles, candles do not give price targets. And I had this cartoon made up. Guy's pointing, thumb signs for Rome. He says, I can't tell you how far it is, but I do know it's that way. And the candles are great for letting you know if it's going this way or that way. It's not going to tell you how far it is. So price targets, many, many ways to get price targets. I showed you some Western technicals. One of the ways I use, I keep it real simple, is pivot highs and pivot lows. And be careful, this is different than pivots when you're looking at intraday charts, because there's something called pivot points, where you add the high, low, and divide by 3. A pivot high essentially is a high, and I'm going to show you examples of this. It's a recent high, pretty much. It's a high that is higher than the session before it and after it. So it's essentially where the most recent sell-off began. So this is a pivot high. So let's say the market is here. This is a pivot high here. It's a recent high. We'll look at some charts. And this is the next pivot high. A pivot low, so we're over here now. A pivot low is a low that's lower than the session before it and after it. Okay. So here, on this green arrow, this hammer, just show you some pivots. So this is a pivot high. In other words, this high is higher than the line before and after it. This is another pivot high. And this is another pivot high. So my first resistance, minor, would be here. This would be a little bit more important. Why do you think so? Why do you think it would be more important than P3? What's happening? Well, black real body, but it's also, beside a pivot high, look. Yeah, not so much even the candle signals. What are the highs What are the highs doing here? They're kind of right around the same resistance area, right? The more often a support or resistance is tested, the more emphasis I placed on it. So this to me would be pretty important. And then this pivot high, because it's a major high, it's quite a major high, I would place a lot of emphasis on here. So these are just examples of pivot highs. P3, I wouldn't really pay too much attention to it. P2, I would be cautious about. So if I saw this as a potential buy, I'd be looking for any potential reversal signals here, but to me it would be really minor. This is where my initial target would be, because it was tested many times. So I would actually have this as R1. I wouldn't have this as R1. I would have this as R1, and this is R2, because it's a significant high. So when I look at targets, I'll look at recent pivot highs and pivot lows. Okay, box range breakout. To get, once again, this is a longer-term target. I just want to give you some ways of getting price targets. So here we have the box range breakout. You take the height of the box range, and you add it to the breakout area and get a target there. We got a doji. confirming the target. Bull flag. These are just ways of getting targets. Okay, one of my favorite is, as I mentioned, using recent highs. So here we had, and we saw this yesterday, this is when Bear Stearns collapsed and the market broke under the support level, and the bears failed to hold the market under there. Okay, we're talking about the psychology. If the market can't go down in bad news, what does that mean? It's going to go up on good news. Now we also, since we have Western technicals, we went through, what was that signal, the Bear Stearns collapse? Not a candle signal. What's one of my favorite signals? Crack and snap. See it? Market cracked under there. Now, with the crack and snap, your target is the most recent high. But in this scenario, what I was looking at is this. There was, and let me do this here because you don't know what's going to happen after, right? So let's get rid of this stuff here. Okay. Was the market in a box range? Yes. Did the market successfully test the bottom end of the box range? Yes. When that happened, my target was the top end of the box range. Okay, just show some of the ways I get targets. Kraken falling off the roof. Target. Right? I'm just kind of going through ways. We can get targets. Channels are nice, just like box ranges, top and bottom box ranges. If we start at the top end of the box range, we may go to the bottom end of the box range. Same idea with channels. You rally from the bottom end to the bottom of the bull channel, you may go to the top end and vice versa. So, here, for example, we have a bull channel. Extend the bull channel. Top end, this is a nice chart to show you the power of east and west. The top end of the bull channel, bearish engulfing pattern, so we have an east plus west, candle signal plus western signal. Now we also use west for price target. The market's still at the top end of the bull channel. Where's a potential target? Bottom end of the bull channel, right? Okay, we don't know it's going to break under it, but that's a target. And just a little bit of a nuance for those who are familiar with channels. One of the things you could do very often, you could make parallel lines. So what happens is if you have a rising support line or resistance line, you can actually, a lot of times they're parallel. So what I've done is, see how it overlaps? A lot of times you'll have parallel channels, parallel lines. Okay, so we have a protective stop. We now looked at some ways to have a price target, so we discussed protective stop. So what does that give us? It gives us my most important trading rule. Dum dum dum. Should I walk out again like I did yesterday with right? All right. It's risk reward. Okay. A candle signal, even if it confirms other signals, is not enough of a reason for a trade. You must always consider risk reward. And we get so much good feedback about just one aspect. They say this one part just pays for the whole seminar because people didn't take it into account how vitally important it is. And if you remember one of the slides we showed at the beginning of this presentation about when to use a candle, remember thumbs up and thumbs down, to initiate it's interesting because this will be sold overseas and certain things being different overseas. It's really interesting. So I don't know if this is a curse somewhere. Interestingly, in Japan, this is okay here. If you do it upside down, I'm not sure if it's this way or this way, it means money. So, but anyway, with the thumbs up for initiating a new trade, I said it confirms a candle signal has to confirm another signal. It's a necessary but not sufficient reason, because even if a candle signal confirms another signal, if it's a bad risk reward, you don't do the trade. Make sense?
Yes.
Yeah. Tattoo this on your body, however you want to remember it. Etch it, I don't care. Always remember risk reward. Okay, we saw this slide a lot. It just has so many great technical aspects to it. So I'm not going to go through the elliptical lines again. We know the red arrows are bearish engulfing pattern, but I wanted to get to here. And the reason you correctly pointed out was that you would not be buying on the bullish engulfing patterns because of the falling window. But let's actually go a little deeper level. We said the falling window, but that's really not the reason. The reason is it's a resistance. It's a bad risk reward. You're buying at a resistance area, right? If you're buying it on the close here, and your resistance is here, and your support is here, you're risking multiple times what you're looking to make. Again, risk reward, meaning your risk is your protective stop, how much you're willing to risk. Your reward is your profit potential. That's why we looked at the two aspects separately, protective stops and price targets. And we could use candles to help project stops by using the low of the hammer or the high of the shooting star, whatever it is. Targets, nothing to do with candles. That's why I have a whole section on Western technicals. Okay, a little hard to see here, but we got I got an email from somebody who attended one of my seminars, and he said he went long, and this is a green bullish engulfing pattern. So green is the white candle, what we looked at as white candle. Red is black real body. So he went long here. He says he went long bullish engulfing pattern at support. This is an intraday chart. It is I'm not sure the time period, but it's an intraday chart. And this is a support area. So a bullish engulfing pattern as support. Great. Other spinning tops confirming support. So looking down here, over here. Trend line break of the price. Okay, you see the short-term downtrend over here? So the bullish engulfing pattern broke a falling resistance line. And he actually had other indicators. He looks at exponential moving averages and things like that. And everything was lining up. And he says, was this a good trade that just didn't work out? Which is always possible. You can have everything lined up. You know, the Japanese say, just because the water's calm, don't think there aren't any crocodiles. Okay. Everything could be lined up, and it doesn't work. You just don't know. Or did he make a mistaken judgment that I can't see? He made a mistaken judgment. And the mistaken judgment was this. This is where he got the signal. Okay? This is his target. And that's his stop. That is not a good risk reward. He had everything lined up. Remember what I said? It's a necessary but not sufficient reason. He was right with all the indicators. Everything was lined up. It was just a poor trade candidate. Everybody see that? This is just so important. Two hammers, and this is a beautiful chart to really illustrate how people really misuse the candles, who buy on every hammer or sell on every shooting star. Two hammers. Okay, one has a white candle, real body, one black, it doesn't really matter. But we trade completely differently. Now, assuming these confirm support. Remember, we don't initiate a new trade, a new position, unless it confirms support. So let's see, both these hammers are confirming a support area. The first hammer in the blue arrow as compared to the second hammer in the green arrow, from a risk-reward perspective, would you do one? Would you do both? Which one would you do? The bottom one, right. With the idea that the target is the falling window. Your target might be different. You might be looking, I don't place much emphasis on it, but you might be looking at an angled trend line. Okay? If you find in your markets that trend lines work real well, that would be your potential target. Okay? But I'm showing you how I look at the market. So isn't it fascinating? Same candlestick signal, but how it appears through the prism of the overall market shows us how we should trade completely differently. Okay, and actually this is what happened after, in case you're interested. So what happened was, after the first hammer, the market really didn't do anything. It came down. The second hammer, came, and this actually, I wonder if this one here is also a hammer, maybe not. I don't know if the lower shadow is not twice the height of the real body. But anyway, hammer here. We all agree, right? There's not a bearish engulfing pattern. Black wrapping around the white. The trend is wrong. Okay, the second hammer, and this is very typical. See how, remember we talked about the hammers? A lot of times the market gets to the lower shadow. Very typical. So here we got into the lower shadow of the hammer. The market rallied and got to the window and stalled. Okay, same signal. Two bearish engulfing patterns, but how different the strategy. First bearish engulfing pattern in the first blue arrow to your left. If you sold it there, you're selling at support. Bad risk reward. Second bearish engulfing pattern. Assuming that window is still your target also. Is that a good trade candidate? And assuming it's confirming a resistance area. And actually, even if it's not, the fact that you have a couple of highs there would be a reason to think about at least slightly short. But if it confirmed resistance, that would even be reason to be more aggressive. But let's say, would you sell there as opposed to the first bearish engulfing pattern? Sure. A much better risk reward, or reward risk, depending on how you want to say it. Okay, here we have a Dragonfly Doji, by the way. Great hammer. This gets back to a question I was asked yesterday. Look at that long lower shadow. Oh God, this market's going to infinity. Right? It's already made its move. That's a great way of putting it. It's already made its move. Look at how much the market's off the lows. So now there's no problem with that long lower shadow as long as your target is way up high. Okay? But what I had here is my short-term resistance area, which was tested. It was a pivot high here. This high had a higher high than the prior sessions, also for about 3 sessions in a row. And actually, you can even look over here, right? So this would be my resistance area of concern. So if you're buying on this hammer, your target is up here and your risk is all the way down there. So just because you have a really long lower shadow doesn't mean you do a long trade. In fact, it's actually riskier because you're risking that much more. Okay, here, bearish engulfing pattern. Change of polarity. And what I want you to really do is get very comfortable looking at where there's prior resistance and prior support, because I want you to be able to do as quickly as I do, when you see something like this, resistance, 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 mentally convert, all resistance becomes support. Just like if the market, let's say the market broke under here. As soon as it comes down here, even if it's, it's 3 sessions, it's close. It doesn't close to one another. It doesn't matter. As soon as the market breaks under here, I want you to be able to see, okay, we had support for a few sessions down here. Old support. I might actually make it a band. Old support area becomes resistance. I want you to be able to pick that up as fast as you can pick up windows. Windows are easy to see. Really get used to looking for prior support, horizontal support, and resistance. Really, really important. Here. Okay, so this is part 1. So the market is at a change of polarity, a potential support area. Obviously, based on this daily chart, no reversal signals. What's one way around it? Intraday. We can look at intraday to see if there's anything happening down at that support area. And if there is, then we can think about buying it. But based on the daily chart, which we're focusing on now, no turning signals. Now what we're going to be looking at is the same chart. So the markets, this is the change of polarity area. Let me go back here. Oops. Okay, so I should have extended this. This is the change of polarity area. Okay. It's actually right around over here. Okay. And right at the change of polarity, what happened in the next session. And this, to me, not enough of a downtrend, but nonetheless, the market bounced back. So the market now is at a potential resistance area, and we're going to go through here. But the thing about this from a risk-reward, it's at a resistance area. We have a tall white real body, so can we do anything? No, the market's at resistance. There's no sign the market's turning, so we can't sell it here, and we can't buy it here because we're too near resistance. And a lot of times, you don't always have to be in the market. Times to buy, sell, and stand aside. Okay, so we go for the next session. We're kind of doing candle by candle here. The market's at resistance. Are we getting any signs that the prior bullish momentum implied by the long white candle is changing? Yes. Now, how about from a risk-reward perspective about selling this, either selling short or doing a bearish option trade? It looks fine. It looks okay. It's not a high probability reversal candle signal. It's a small real body. But at least now we're near resistance. The market's running out of momentum. And from a risk-reward perspective, it looks okay because our stop would be here and our target is still down in this area over here. All right. And this is actually what happened. And one way to trade around this, if you're nervous over here on this spinning top, once again, there's a lot of things you could do with confirmation. You could wait for the next day. So either if you're flat here or you're lightly short here, when the market starts moving down the next day, you could add 2 positions because it's confirming the potential turn over here. You don't have to wait for the end of the session. And of course, you can look at an intraday to see if there's any reversal signals there. But so same levels up here and up here, but one gives us a better risk-reward because we're getting a potential turning signal at resistance. So we're increasing likelihood of the market turning, and then we have a good risk-reward up there. Look at that bearish engulfing pattern. But let's think about the risk-reward. Okay, to me, this looks like a fairly important short-term support area. The market had a really nice bounce from there. So this is a support area. So if you sell it here, poor risk-reward. And we talked about this yesterday. If you had, let's say, a bullish engulfing pattern with a really tall white candle, by the time you got the white candle, a lot of the move was made already, so you could use the low of the bullish engulfing pattern as support. Here, it's the same concept. You could use the high of the bearish engulfing pattern as resistance. As the market gets to there, look for potential turning signals with the candles. So one of the things I used to say in my marketing material is when to ignore a candlestick signal, and it would be a case like this, like a long bearish, a black real body, a bearish engulfing pattern. But I realize ignore is the wrong word, because you don't ignore it. You still remember the bearish engulfing pattern because you're making it resistance. You don't trade on it on this signal, but you really don't ignore it. You remember it in the back of your mind, or on the charting software you put a resistance area, and if the market gets near resistance, either through a daily candle signal or intraday. All these doji, and by the way, the plural of doji are doji. Right, it's doji. Almost everybody says dojis. That's okay. And here we have, and it's interesting. Doji actually means, if I understand it correctly, at the same time. Okay, and I'm not exactly sure why it's called the doji, because this is really at the same price. So, but not exactly sure why. But here we have a series of doji, and the blue arrows, although they're cautionary signals on the doji, here we have a doji in the red arrow. Is it as significant as far as a reversal signal is concerned? Well, think about the risk reward as the other doji. No? Rising window. If you're selling on that doji, you're selling right near a support area. And again, it's all about risk reward. Candles in context. Okay, this happens to be RIM. This is interesting. This is very similar to the S&P. I was looking at before. Remember, we had a bunch of bearish signals when I was on Bloomberg TV, and although there were bearish candlestick signals, I wasn't negative. And the same thing here happens to be in RIM. We had a bunch of reversal signals here, a bearish engulfing pattern, actually a series of bearish engulfing patterns, 3 of them. But why would we not be outright bearish? I wouldn't be going long, but why wouldn't we be bearish? I want you to get used to looking at support and resistance. You should see this right away. Right. You've got to be able to see this, especially something so obvious as that. Exactly. And I'd probably make it a little bit of a zone. I might actually go over here. But change of polarity. And this is what happened after. So if you went short here, if you just knew enough to be dangerous and knew only about the candlestick signals, I'd be all over this trade from the short side, because you didn't bring the aspect of Western technicals and trade management into this, risk reward and so forth. And off it went. Okay, same thing here. We have a bearish engulfing pattern here, confirming resistance. Look at this. Look at the falling window. Everybody see that? Bearish engulfing pattern, a candle signal confirming my favorite favorite candle signal, a falling window, a bearish engulfing pattern. But let's think of this from a risk-reward perspective. First support would be here, and next support would be there. Can't do the trade. Market gaps higher. There's a breakaway gap. This rising window becomes support. We should be looking to go long. But the main thrust of this is that this is also an evening star. Everybody see that? An evening star, bearish engulfing pattern, confirming resistance area. Even if you didn't know about the window, you'd see it be confirming resistance area. So candles confirming a resistance area. 2, but not the third thing. What's the third thing? Risk reward. Here we have a rising window. In the blue arrow, a morning star. Lots of bottoming signals. Big deal. Because look at where your target is. Right there, right? So really need to, although it's great, you're going to pick up these signals, and you're going to say it's confirming a Western signal or other candlestick signals, the candle signal confirming Western signal, other signals. Always look at where your target is. See if it's a good risk reward. Crack and snap. Okay. Now, with the crack and snap, our target is the recent high over here. Of course, we have the falling window as resistance. But even if you use this high, you'd have to see if this is a good risk reward. And I don't think it is. It's probably a 1-to-1 reward risk. Bearish engulfing pattern over here. But look at where support is. Look at this bullish engulfing pattern wrapped around 1, 2, 3, whatever it is. So if this is your target, if you're selling it here, your risk is greater than your potential reward. Everybody see that? Make sense? And we'll go through these quickly. Bearish engulfing pattern, dark cloud cover, oh boy, but rising window. Dragonfly doji. And we think it's pretty powerful at long lower shadow. But what? At resistance. What's the resistance? Change of polarity. Again, I use this so frequently. Change of polarity, crack and snap. Okay. And then the market actually did a crack and snap. But the point is, you wouldn't have sold it. You wouldn't have bought it there because it was right at resistance. The next session, everything had changed. What happened here? A bullish engulfing pattern, a crack and snap. There again, you'd have to think about the risk reward, right? Because your target, at least my target, would be up here, and your risk is really down to here. So although it changed to positive, you still couldn't have done anything with this particular trade. So in both scenarios, you couldn't have done anything. You had a bullish, potentially bullish dragonfly doji, but you're near resistance, and by the time you got the bullish confirmation, it wasn't a good risk reward. And here, and we saw this before, the bullish engulfing pattern of the window, but I just wanted to show you all the other signals we had, a morning star over here. Sorry, a morning star over here. So another potential bottom reversal signal. We had a bullish engulfing pattern here, morning star here. But problem is the infamous falling windows or falling window. Okay, now we're going to be looking at trend. And we've touched on one of the aspects of the importance of trend. And this brings us to one of my trading principles. A candlestick line or pattern requires two criteria. We know the shape of the line or the candle line or the candle pattern, but we also need to have a trend to reverse, a short-term trend. Just as so, for example, a shooting star should come after a rally, a hammer must come after a downtrend, and this is a common misuse of those who think, once again, they understand candles. They don't look at the trend immediately preceding the candle signal. Now here we have a bearish engulfing pattern, black real body wrapping around a white real body, and we have a bi-weekly educational video. I try to do it every 2 weeks depending on how busy I am, and this was actually one of them we did a while ago, and Bob emailed me back on this, and he says, I love your analysis, but I have a question. Wouldn't the next candle after the bearish engulfing pattern be a bullish engulfing pattern and negate the bearishness of the first candle? So what Bob's asking is on this yellow arrow, I made the white wrapping around the black, he's saying, isn't this a bullish engulfing pattern? Yeah. And he understood the shape, the combination was right, but the trend was wrong. Okay? And this is a very, very common misuse. This is an email I got quite recently, actually, and it's a little hard to read here. But it said, Steve, your comments are conflicting, see attached. And what Jerry had mentioned was, and I'm going to read this here, and we're going to look at this. We have a bigger slide of this. It says, conflict of signals. You are calling a bullish engulfing pattern, and it is followed by a bearish engulfing pattern, by your definition, which is not true. And here's what Yeah. It's interesting how he knows what my definition is. If he did, he wouldn't be calling that a bearish engulfing pattern, right? Only my wife could speak for me, nobody else. So we had a bullish engulfing pattern here, the white candle wrapping around the doji. And let me just show you a little highlight, what he's talking about. So here was the bullish engulfing pattern. And so he was saying there was a conflict because this is a bearish engulfing pattern. And this is exactly the wrong time to view this as a bearish engulfing pattern. Okay. Again, I've seen traders lose enough money that took them months to recoup by thinking that there's a candle signal without thinking about the trend. Imagine selling down there. And even if it was a bearish engulfing pattern, which is not, why wouldn't you sell down there? What's my most important rule? Risk reward. You're doing it right near a support area. Black wrapping around the white, neither one of them is a bearish engulfing pattern. And we all know why. The trend is wrong. White wrapping around the black. Look at the multiple times. Okay, look at the multiple times that white candle is bigger than the black real body. Oh, my goodness. Now, the white candle is a positive. There's no doubt about it. But it doesn't meet the criterion of a bullish engulfing pattern because the trend is wrong. And once again, even if it was a bullish engulfing pattern, why wouldn't you buy on here? Risk reward. Great. Exactly. Not a bearish engulfing pattern. Trend is wrong. That, to me, would be a shooting star, even if it's a little bit of an uptrend. What I mean by an uptrend, 3, 4, 5 sessions. Okay, that is a shooting star. Now, that aspect we looked at as far as defining the candlestick signals. We need to look at a short-term trend to make sure that the candle signal is confirming the trend. In other words, a bearish engulfing pattern has to come after an uptrend and so forth. Now, from a little longer-term perspective, going with the trend, use very short-term trend to determine or define the candle signal, which we just did. Then, for those who want to go in with go in the direction of the longer-term trend, you look at this, and then use the longer-term trend to position in the direction of the new trade, to set the position in the direction of the new trade, unless you're looking for a short-term move. And let me go through this. The odds are much better when you're going with the trend. With candles, we're trying to pick tops and bottoms. High risk, but there's nothing wrong with that if you're trying to pick a short-term top and bottom, but within that short-term, let's say the market's in a longer-term uptrend, and you have a correction. So now you have a little downtrend, you have a hammer, which meets the definition because of a little downtrend, but that correction is within a longer-term uptrend. If you go long, you're really going long within the longer-term trend. Okay, so let me show you ways to do that. Now, the exception to that would be if you're looking, in other words, if you have, let's say, we're neutral or a downtrend, and we're in a downtrend, and the market is moving down, and you get a bullish candlestick signal, it's okay to buy. Realize you're going counter longer-term trend if you're looking for just a little bit of a move. All right, but if you're looking for a more significant move, you really should be trying to go with the longer-term trend because otherwise you're kind of going against the force of the wind or whatever. Now, here we have a falling resistance line, so we could view this as the longer-term trend is down, so you'd be looking at maybe selling, going short on this rally over here. So you have a series of small real bodies, the doji confirming a resistance line. Again, I like horizontal support and resistance, but if you have a resistance line tested so many times, I certainly pay attention to it. So while the longer-term trend based on this, and you may have your own definitions of trends, but I'll show you some of the ways I use trend as far as definitions is concerned. So you have a short-term rally within a longer-term trend, so you're getting a bearish signal saying the short-term trend may be running out of steam, and now you're going short in the direction of the longer-term trend. Make sense? Yes. Right. And this is really important. This is really going to help a lot. Here again also, now we have some bearish shadows. Okay. Lower highs, so we could say, okay, the major trend is pointing down. And then we have a dark cloud cover, which is confirming, so we have a short-term uptrend here, and this dark cloud cover, a bearish signal, is confirming a bearish longer-term trend. Now, an easier way might be, because trend lines are kind of subjective, right? So you may want to use something like moving averages. And so, for example, here, and these are some moving averages I use, a 20-day and a 50-day moving average. You may want to adjust them depending on your markets. So here we have the 20-day moving average, which is a solid blue line, is under the 50-day moving average. So this is a way you can define trend. Somebody had asked about dual moving averages. And actually, there's something called golden and dead crosses. Again, I didn't plan on talking about it here, but a golden cross in Japan is when a short-term moving average crosses above a long-term moving average, and a dead cross is the opposite. But we're not focusing on that here. Here we're just actually looking at two moving averages as a way to define trend. So we have the 20-day under the 50-day moving average. So we could say the trend is down. And if you want a little extra confirmation, they're both sloping down. So now we say the longer-term trend is down. And the reason I like 20 and 50-day rather than really short-term trends is because we're looking at the longer-term trend. With the candles, we're only, as far as reversals, we're only looking at short-term trends, but we want to be in the direction of the longer-term trend. So we say the moving averages are sloping down, the 20 is under the 50, trend is down. We have a short-term rally. So now we met one of the criterion, right? We need, for dark cloud cover, has to come after what? A rally. All it need be is a short-term rally. So we have a short-term rally, we have a bearish signal. Everybody see this? This is like a light go on. Okay, this is, again, this is really going to help because you're going with the major trend. Okay, you're just using corrections within the major trend to initiate a position. We get a bearish signal within a bear trend, you could go short, if it's assuming it's confirming a resistance area. Remember, and think about risk-reward. All right? If we got a bullish signal, for example, in a bear trend, we may use that to cover shorts. We wouldn't be as aggressive. And on the right here, we have a box range, and it just shows that the market's really trying to stabilize, but we're getting bullish signals in a bear trend. Everybody see that? So it's okay to look for a short-term move, maybe we have resistance here, but maybe over here. If you're buying a piercing pattern, if you're going long, realizing you're going against a longer-term trend. And if you're looking for a buy, it's fine to do. Realize you're going against the trend, and you should only be looking for not a major move on the upside because you're going against the trend. Now we're going to look at the opposite here. The 20 is above the 50-day. They're both sloping up. The longer-term trend is higher. We have a little correction. Everybody see it from the doji, almost the gravestone doji over here. Correction. This definitely defines a short-term downtrend, so this, to me, would be a hammer. And the hammer is probably coincidence that held the support of the 20-day moving average. But now you're having a bullish signal within a bull trend. It's just a short-term correction. Here we have 20 over the 50. We have a rising. Here, if you're shorting here, because the 20 is over the 50, you'd look for a minor correction because you're going against the trend. You're selling short, and this is a fine short sale because even if it's not confirming resistance here, you have 3 sessions around the same highs, an evening star. So if you're shorting here, you're only looking for a little bit of a down move, and it may not be a good risk reward because our first support would be the rising window. Right? Somebody had asked about what if you have 2 windows, a rising window as support, a falling window as resistance, and this is exactly what we had in this particular market. And what happened was we had the falling window as resistance. Everybody see that? The rising window as support, and you know it's going to break out one way or the other. How can we tell the likelihood? What increases the likelihood of a breakout? Well, perhaps throw a moving average on here. Okay, and for Amazon, I was using a 30-day moving average back then. So the 30-day moving average was pointing up. It showed us the trend was up. So that increased the likelihood that the rising window was going to be successfully defended, and the break would be above the falling window because the major trend was up. Here we have a series of rising windows, and this is when you can be more aggressive on the long side because you're long on the windows and you're also riding an uptrend. See, what's nice about the windows, it's not a reversal indicator. So you don't have to worry about if you're getting a reversal indicator within a longer term, a bullish reversal indicator within a bear trend or a bull trend. A rising window, if you're in a longer term uptrend, it depends how you define uptrend. You could look at a bull channel, you could look at a moving average. So here, if you're buying on the rising window, you're going in the direction of the trend. If you have falling windows and you're looking to sell short on falling windows, you should be in a downtrend. Because the falling window, it should be resistance, and again, you're going in the direction of the major trend. These are all rising windows. Okay, you may want to use channels. So here we have a daily chart. This happens to be the spiders. And we're within a bull channel here on the daily chart on the left. It's a bull channel, so the trend is up. And if you trade intraday, you're saying, okay, we have a short-term correction here. We have a hammer, a bullish engulfing pattern. So although the market is moving down short-term intraday, within the context of the daily chart, we're in the market's in an uptrend. Now, for those who trade really short-term intraday, if you look at a 5-minute, to you, maybe the bull channel will have to be on a 30 or 60-minute chart. I would also look at the daily chart. I always would have the daily chart. It doesn't matter what time frame you're looking at intraday. Always look at the daily. But this is a nice example of using a time frame of a higher degree to see the major trend and using a time frame of a short-term trend to be in the direction of the major trend. And if you normally trade daily, you may want to have a weekly chart on, right? So you may have a correction on the daily chart. Let's say the market's moving down, you have a bullish engulfing pattern, but on the weekly chart, you have a nice rising channel. Now, one of my more advanced topics is sector analysis with candles. I just wanted to show you an example of that here because we're talking about going in the direction of the trend. And one aspect of that is looking at the sector that the stock is in. Okay, because there's been studies anywhere from 38% or 60% of an individual security, individual stock is affected by its sector. So you may want, for example, you're thinking about, and this is actually one of the slides from one of my advanced sessions on with sector analysis. So you're thinking about buying Amgen, I would suggest looking at the biotech sector. You know, if Amgen, although it has a tall white candle, which did break above a rising window, if the biotech sector is in a bear trend, I wouldn't be going long. So here it's fine because Amgen, the biotech tall white candle broke above resistance, so this is fine. So again, just something to think about if you're not already. Always think about using the sector that the market is in. Now we're going to look at news, and this will be very easy, very short. Okay, if you expect news, stay away from the trade. Okay, the challenge is sometimes news that comes out you're not expecting. You have no control over that. But if you know earnings reports coming out, a balance of payments, an unemployment number, just stay away from the trade because we're trying to play the probabilities and want them on our side. If you're doing a trade in front of an important number, it's a coin flip, and we don't want that. Okay, if-then principle. And by that I mean if the market does not act as forecasted, then exit the position. Okay, that's what protective stops are about. Initiate a new position when the market justifies your potential trade. That is, if the market breaks above resistance, then you can think about buying it. If the market does something different than before, then adjust your trading strategy. Let me show you some examples here. Most people don't realize this, but a double top is only a double top when the intervening low is broken. This is not a double top. This is a potential double top. This is when the double top was confirmed. So then you can shift over into, there's a box range, and you can shift over to change of polarity. But the double top is only confirmed by a break under the low in between the two highs. So if you're thinking of selling on the double top, then the market has to break under that low. Then you could actually take a price target. Okay. Head and shoulders top, right? No. It didn't break the neckline. If I added the word potential head and shoulders, the answer would be yes. This is not a head and shoulders top until the market breaks the neckline. And this is where traders really get burned. They try to outguess the market. If you want to do that, and you're right, you've made more money because you've beat the rest of the competition, but you have a much higher percentage of it not working out. And this is actually what happened after. Okay, the neckline held. This is still a support area, folks. Okay. Inverted head and shoulders, potential inverted head and shoulders. It has to break under or above the neckline. This is what happened after. So if you're trading this based on the idea it's a head and shoulders, if the market breaks the neckline, then you initiate the trade. That's one of the if-then ideas. If such and such, then you react in such and such. Nice ascending triangle, making higher highs at resistance on this white candle. Looks fine, but it's not an ascending triangle until the market breaks above the resistance area, which it did not do, and look what happened after. Here we had the head and shoulders confirmed. So a close under the neckline will confirm the head and shoulders. Okay? Now the market is near a support area here on that red arrow that just emerged. Any signs that the bears are losing steam? No. So that does increase the likelihood the market will break support, but we don't really know that until it does. Right? Is there something different? No. So here, and there's nothing specific I can really tell you about it, just by looking at the market and see if there's something different now than what's happened previously. So what I noticed here in crude is the market would move up and then have a correction. Okay, stairway to heaven, right? Gets overbought, corrects, moves up. And all the correction lows, starting from here, all the lows that corrected were higher than the prior lows. This low was higher than that low. This low was higher than that low. And what finally broke the cycle is that the correction low here, if the market was following this cycle, or whatever you want to call it, this pattern of higher lows, that meant when the market pulled back here, it should have held above here and then rallied. It didn't do that. It made a lower low. Beside that, we had a classic evening star, a bearish engulfing pattern. We're going from higher highs to the same highs. Everybody see that? A lot of reversal signals here. But the real confirmation came by this break of all the way down. We had higher lows until that time. So if you see something in the market that you follow really closely, that there's something different, and once again, this has happened to be something I saw in crude, but it may not always be the same for a market you're looking at. If there's something different that's going on in your market, realize that it could be an early indication, an important indication of a major turn or an important turn. Now we're going to be looking at being a market chameleon, and what that means is adapting to the market. What we've done so far in the trade management section is look at aspects about, do you buy, do you sell, do you stand aside? Okay, buy or sell, you need to have a candle signal, ideally confirming a Western signal, and what else do you also need? Risk reward, exactly. If not, if it's a bad risk reward, you stand aside from the trade. We looked at the idea of the candles as far as exiting if you don't have a confirmation of a Western signal, and so forth. Now we're going to be looking at what happens after the trade. And one aspect, there's a lot of aspects to that, but one aspect is obviously staying alert. And what that means is adapting to the market. As market conditions change, we need to adapt to adjust to what the market is telling us. We need to adapt our trading stance. And as I mentioned before, I call it a market chameleon. As a chameleon changes its colors to an environment, we need to change our stance according to the market. And some people just don't do that. So this guy's shivering here, and she's wearing a winter jacket, and accept it, Ed, summer's over, right? You know, some people just don't adapt. Okay, the Japanese say what the wind brings, the wind takes. Okay, so with that in mind, the market broke above a resistance area. The wind is bringing some bullish omen or bullish aspect. But then the next session, look what happened. Not only is it a doji, but what happened to look at that resistance area. It couldn't hold above that resistance area based on the close. One of those falling off the roofs. But even if you did not remember that, the doji is certainly showing you to think about adapting. The market breaks above the window, breaks above resistance, not decisively, but nonetheless above resistance. I would have volume on this, right? We'd have volume to break, to confirm it. And the next session, everything had changed. So we need to either scale back on longs or pull back. Okay, so here, okay, we have a hammer over here confirming a support level. Market breaks above resistance. We'd be looking at change of polarities, potential support. So we're going to move along. Here's slide 2. So say we have, let me go back here. So the market broke above that red line. And I wouldn't be buying it here. It's not a good risk reward. But let's imagine that you did, for some reason, buy it over here. Maybe intraday you saw something, a breakout. You bought it here, and your target is up here around 119. So the market does this. You're happy. We're getting close to the target now. Anything warning you that there's something different? Shooting star, upper shadows, right. And that's pretty close to the target. And then even if you didn't get out of the long here, look at what happened. The market was making lower highs. You didn't even have to wait for this. Lower highs, small real bodies, a little bearish engulfing pattern. So while your target originally was up here, the market, as it got there, was telling us that it was having problems even before the target. So you'd be scaling back from your long positions. Okay, here we have an evening star. Okay, the initial target, okay, my first support would be down here. Okay, and I'd have this as minor support, but we had a couple of days down here. This would be my S1. I would have to see if there was more resistance here. If there was, I'd probably use change of polarity, not sure. But my major support would be down here. So let's say that's our prime target over here. Okay, so on the Evening Star, or even on the Doji, whatever, let's say we sell it. You see something intraday, or we have the Doji over here, and the next day the market's pulling back. We start putting on a short position. For whatever reason, if you're negative here, our target is down here, right around, this is GM, right around $9. And speaking of GM, there's a technical rule that works 100% of the time, all the time. Okay? Ready? There was excellent support at 0. Okay. Ooh. Ooh. No, GM actually bounced. I mean, I haven't seen it in a few weeks, but I think GM's bounced back. So our target is down here. Now, let's imagine, so to be safe, if you sold here, or let's say you wanted to wait for a break of support. So let's say you sold over here, and you could use change of polarity. Old support becomes resistance. So let's say you sold it over here, an Evening Star over here. Let's say you sold it over here. Your target is down here. Your stop on the close, or if you want to be conservative intraday, but on the close, change of polarity. So you're short here. Your target is here. And look at what's happening over here. Anything happen here to change your mind about getting to your target? Yeah, look at this. We have a support level right around 950, a hammer over here. So although your target was down there, the market was telling us it was stabilizing down at that level. So it's certainly time to readjust your target and time to take some profits. There's that hammer. Okay, here we have a bullish engulfing pattern. And by the time we got the bullish engulfing pattern, right near resistance, right? So we say that we want to wait for a correction, assuming there's nothing intraday. We could look at an intraday chart as a way around this issue. But let's say you don't look at intraday, or don't have access to intraday. We look at the low of the bullish engulfing pattern as potential support. So we wait for a potential correction to the low of the bullish engulfing pattern. And a few days later, okay, this is an Evening Star, by the way. A few days later, look what we get. This is enough of a downtrend, a hammer. Now, now, and let me get rid of this stuff over here. We're over here. Is the low of the bullish engulfing pattern our first support, or do we have first support somewhere else? The low of the hammer. See, the hammer wasn't there when the bullish engulfing pattern was formed, so we have no way of, there's nothing to adapt to. But now that the hammer is there, that becomes our first support area. So you could think about buying when it gets there, because you may say to yourself, that's support. It may not get down to the second support area. So for those who were not able to adapt by recognizing the hammer as first potential support, could have missed a nice buying opportunity. And that would have been an okay risk reward. Very important slide. This is a concept that I go into a lot of detail from my advanced seminar, but it's so important that I wanted to touch on it, or actually go a little bit more in depth here. And it's a really good way to conclude this section on trade management. And it's this idea of looking at candles in isolation. Looking at candles by themselves is, as the Japanese would say, like leaning a ladder against the clouds. Okay, nothing solid. So, which is a better sale, whether it's a short sale or you're looking to take some profit from the long side? Scenario 1 or scenario 2? The correct answer is, drum roll, you don't know. You don't know, because you're looking at the candle pattern in isolation. How many times have I said that? Candles are a tool, they're not a system. It's a trick question, that's right. And it's a really good way to kind of bring everything together. Let somebody else say, okay, scenario 1, the black real body is multiple times the size of the white real body. It's a much better trading opportunity than scenario 2. There's no way of knowing unless you put it in the perspective of where it is within the market. You got it now? Everybody really understand this. It's really important. Let those who just traded candles buy and sell in every one without looking at the overall technical picture get blown out of the market. So here, this is an actual example here. Scenario 1, scenario 2. And actually what I did is I just cut and paste these patterns from this slide here. Look at scenario 1 and look at scenario 2. Now, which is the better risk-reward? Assuming that they both confirmed resistance and you're thinking of selling short. Okay, which is the better risk-reward? 2. Because by the time you got the signal with scenario 1, it's a bad risk-reward. Okay? And let's bring it all together here. Here's scenario 1. Okay? And here's scenario 2. Wow, right? So now we see scenario 2 is confirming resistance defined by scenario 1. So the correct answer, now that we have the candles through the whole prism of the market, is scenario 2. Everybody agree? Everybody see that? Right. I get a lot of questions. Is a bearish engulfing pattern more negative than a dark cloud cover? It all depends on where it is in the chart. Okay? If a bearish engulfing pattern is not confirming resistance and the dark cloud cover is, and the dark cloud cover has a better risk reward than the bearish engulfing pattern on the trade, which one? Dark cloud cover. But if you just thought about the candles in isolation, hey, the black is wrapping around the white, and that's going to be more negative than the dark, and then the black only getting partly into the white, it's not the right way of looking at it. Because you're only looking at the candle signals without, and this is what the trading triad is all about. The 3 legs, candles, Western technicals, and trade management, risk reward, candles and context. Is it confirming a Western signal? So let's go over what we've learned. We looked at candles and context, candles through the prism of the overall market condition. Okay, by looking only at the candles, without the overall market condition, the market environment, it's like, as the Japanese would say, like writing a number on the water. Nothing substantial. Candles to exit. If a candle signal doesn't confirm a Western signal, we use it to exit. A new trade, we need candles confirming ideally a Western signal or some other signal. You might be fundamentally oriented, but some other signal, and then we need a good risk reward. Protective stops. Okay, the Japanese say one sees the gain, or actually a fish sees the bait, but not the hook. Okay, you always have to think about what the hook is, what your risk is. Targets, that's what we need Western technicals for, because when you have stops and targets, you've now defined your risk reward. Risk is your stop out level. Risk is your stop out level. The reward is your potential target. Trend, 2 aspects. Short-term trend to define the candlestick signal, right? A bullish engulfing pattern has to come after a short-term what? Short-term downtrend. From a longer-term perspective, ideally, if you're looking for a little bigger move, you should initiate a new trade. If you're looking to go long on a bullish candlestick signal, it should be within a longer-term uptrend. Unless you're looking for a really short-term move, then it's not that important. News, if you expect news, then stand aside. The if-then principle. If the market does such and such, or if it doesn't do such and such, then you react accordingly. And adapting to the market. Okay, a prudent trader never argues with the market. The market is never wrong, right? Opinions are, but the market's never wrong. Face it, you have to get out. It's not going up, right? So you've now reached the key to success here, or at least confidence. And how many think it was worth your time and effort to come here for the seminar? Yeah, thank you. Now, by raise of hands, how many of you realize that really to continue your to be a successful trader, you need to go to that next educational level, right? I mean, education is what it's all about. Now, one of the common questions I'm asked is, how to continue your education? And what we've done today, and this is a wonderful quote, Musashi, and very famous actually in Japan, and he said, learning is the gate, not the house. You first have to get through the gate to get to the house. And with the golden key of knowledge that you gained today, you now have access to go into the house. For those who want to look through the rooms of the house, and if you like what you learned here and you want to go to that next level to deepen and broaden your knowledge, I would recommend and suggest my advanced educational seminars. There's a Japanese proverb that says, make use of your opportunities. And by what you learned here, and as you go down the path of education, you're going to be able to recognize the candlestick signals and be able to not only recognize the candlestick signals, but how to correctly use them, and just as importantly, have the rock-solid confidence to recognize and seize those golden trading opportunities. And that's what it's all about. Education equals confidence equals trading success. So thank you, and may the candles continue lighting your path to greater profits. So we have.
Congratulations on completing Volumes 1 and 2 of the CandleCharts.com educational resource. Now that you've further ascended the steps of knowledge, it's time to reach the upper levels of confidence and success with Volumes 3 and 4 of the CandleCharts.com educational series. Called Candles Reignited, this 2-day video workshop takes you all the way up to Nissen Expert level. If you don't own Candles Reignited, see the Ready for Next Step sheet included with the handouts of this DVD. Or visit www.candlecharts.com for details about special pricing and exclusive bonuses.